G'day guys, Seeney here, and welcome to another episode on the Australian Wealth channel. And in this episode, I'm going to talk about how to become a property investor. So thank you guys so much for watching. Please make sure you like and subscribe to this channel. It really helps to get these videos out to more people. So there's a lot of people here in Australia that are interested in getting into property development, but they're not quite sure exactly how to do it because it can be something that is really daunting and quite challenging, especially when you haven't got the knowledge. So this is a video that I want to make so I can kind of go through the process step by step so that people can get started in property and look at new ways to build their wealth. Because obviously, you know, we have some ways like stocks and ETFs and things like that that we can invest into to grow our wealth over time, but property has been one of the best ways to increase your net worth and provide financial security for yourself or your family. So this is something that I've been working really hard on the last few years, and I've learned a lot in the last few years, and I wanted to, of course, give that knowledge out to other people so they can learn about the process as well, because it might seem really complicated at the beginning, but it does get quite simple the more you do it. So I guess the first question is, well, who am I to be talking about property development? So my name is Seeney. I am a property investor and I hold about $3 million worth of real estate by the age of 30. It's something that I've worked really hard on over the last few years, and I have 4 properties which I own. Those properties are not only paying off the mortgages that we have, but they're also cash flow positive, which means that they are making me money on top of that as well. I'm not paying anything to hold them, it's putting money into my pocket. So those are my credentials. You know, I don't have a background in finance or anything like that. Very well versed in business, but not so much finance. But I have managed to amass this portfolio in a short period of time, thanks to great appreciation from the property market and buying really smart in great areas. So without further ado, let's get started on how to become a property investor. So when it comes to property, the first property is going to be the hardest, without a doubt, because the thing is, you have nothing else to draw on. So there's no other way around it. You're gonna have to save up a 10 or 20% deposit. Now, the good news is that you don't need to invest in the city that you live in. So if you live somewhere like me, take Sydney for example, where the median house price is $1.4 million, that's a huge deposit that you're going to have to save up. You know, that's $140,000 plus stamp duty and other costs on top of that, just to get a 10% deposit in the Sydney property market for just the median house, not even an expensive house. Now, of course, in the beginning, we probably won't be looking at the most expensive houses in Sydney, but the thing is, you can invest in other cities, and that is in fact what we've done. I purchased my house in Sydney that I live in first, but all of my investing is in other cities. Now, what I'm going to do is step you through the process from the beginning of what you need to do. Now, the first step is obviously the want to invest in property. Now, following that, you need to speak to a mortgage broker. And what a mortgage broker is going to do is they're going to give you a rough idea of your borrowing capacity, because to be able to purchase a property in this particular environment that we live in for the last 50 years or so, you're probably going to need to get it financed. You know, you're going to have to borrow money from the bank because property is so expensive, and it seems to be a much better way to grow your wealth faster. Obviously, you know, there is of course some risk involved with borrowing large sums of money from the bank, but of course this has been an effective strategy for a long time. So what you're going to have to do is speak to a mortgage broker, and they're going to give you a rough guide to your borrowing power to see where you're at. You know, it might be a matter of you need to pump your income up, or your income is at a great level where you can actually get started on investing in property, because it's not only your deposit that matters, it also matters about your serviceability. Are you going to be able to pay back this loan? That's what the banks want to know, and if you can't do that, the bank is not going to lend you that money, unfortunately. So you speak to a mortgage broker, they'll ask for a lot of things like your income, your current debts, whether you have a car loan or credit cards or things like that. Credit cards, each $10,000 limit will knock $50,000 off your borrowing power, and also each child will knock about $50,000 off your borrowing power, so it's worth keeping that in mind. And they'll give you a figure as to what you will be able to borrow from the bank. Now, it's not really advisable to be borrowing the absolute maximum that you can borrow from the bank, because it leaves you in a bit more of a risky position. It's something that you do need to weigh up, is how much debt you have and how much your repayments are going to be. So after the mortgage broker tells you how much money that you can borrow, then you have a rough guide as to what you can start looking for in the property market. Obviously, the first property, you will need to save up a deposit if you want to get in, whether it be 10 or 20%. Now, thankfully, we can invest elsewhere other than Sydney or Melbourne. My investment properties are in Brisbane and Adelaide. I purchased a property in Brisbane a couple of years ago in the Redland Bay region, and I purchased that for $550,000. Now, on this property, I needed to put 10% down. So I put down $50,000 plus stamp duty, which was around $10,000. And then, of course, all the other costs that go along with that, such as lender's mortgage insurance, which happens if you pay a 10% deposit as opposed to a 20% deposit. So all in all, it was around $65,000 to $70,000 to purchase this property after all fees. So this is money that we had saved up, even knowing we'd purchased a property here in Sydney before. We're in a position where we're earning a significant amount of money, and we could funnel that into an investment property pretty quickly, thankfully. So the process of doing that was as follows. We spoke to a mortgage broker, and after we spoke to a mortgage broker, we had our rough borrowing capacity, we had our deposit saved up, and then we had a property sourced by a buyer's agent. Now, this is really important because working with a good buyer's agent will ensure that you're buying in an area that is going to appreciate over time and has good rental demand. If you're doing this for the first time, it's probably not a good idea to just go out yourself and just try and find something, because there's so many different metrics that you need to look at and different variables as to why an area might be great for property investment. So, for example, you need to be looking at population growth. What is the trend of that like? Is it increasing? Is it decreasing? Is it increasing at an increasing rate? All of these things. So on top of that, you need to think about infrastructure that's in the area. What infrastructure projects are going to be happening that are going to cause people to want to move to the area? What's the rental vacancy look like? Are the rents going up? Are they going down? All of these different things. So there's a number of different variables that a buyer's agent will take into account to help you purchase a property in an area that's going to appreciate in value over time. So once you have sourced a property with a buyer's agent, you need to make sure all the maths works. It's very important. I personally believe that you have properties that are going to cash flow, which means that they're going to be making you money on top of all the expenses that the property has. Now, because property has gone up so much, this can be a little bit trickier, but I do believe that you can find both, and if you can't, then you need to look a little bit harder. So most properties will cash flow pretty well with an interest-only loan. This is what we did on the Brisbane property that we purchased up there a couple of years ago. So the rental returns per month are just over $2,000, and our interest-only payment on the mortgage is just over $1,000. So it's $1,000 cash flow in our pockets every month on an interest only. So there's two different ways you can go about financing these properties. You can either go an interest only loan, or you can do a principal and interest, which means the principal is getting paid off over time. We opted for an interest only to start with because it gave us more cash flow, which means we could get into more properties faster. A more conservative approach is, of course, to pay down the principal on that loan as well, which we are in the process of swapping over to now that we have a couple of properties, because interest rates might potentially go up. So you want to make sure that you have a property that is in a place where it's very cash flow positive. So if interest rates do go up, your payments are going to go up, you're still going to be sweet. So anywhere in Sydney, you're not really getting that. You might get that on a few units, but it's more of the regional capital cities where you're going to get things like that. So once you find a property, then it'll go to the phase where you are making sure that you have finance approval. So this is really important. At the moment, banks are incredibly slow, so you have to keep in mind that they might hold you up massively. So I think it's worth getting the process started as soon as you can, even before you've found a property, and then you can send the contracts as soon as they come through to the bank. So you will be getting contracts for the property, whether it be house and land, or if you're buying a townhouse or something like that. Personally, I'd go with with houses in most cases because they're going to appreciate at a faster rate than units, as we have seen in the past. And most people want to live in a house as opposed to a unit, especially in the long term. So once you have your contracts, it's very important that you have a conveyancer go through those contracts, make sure that they make you aware of everything that's involved with that, because some properties have what we call easements, where there might be like something that is part of the contract which has to happen on the property, like you might need to allow access for a vehicle. Generally won't happen in new housing estates, but it's really important that a conveyancer is making sure that you are aware of all of your rights and responsibilities in regards to the property. So once that's done and you're happy with the deal, you've got your contract price and everything, then you sign the deal. I think when you're signing a deal like this, it's really important that you have a clause in there that is subject to finance. So that means if the bank ends up denying your loan, it means that the contract is null and void and won't proceed. That way you're not going to lose any money. So all of my contracts, I make sure that there's a finance clause in there, that it's subject to finance. So for whatever reason a loan doesn't go through, I'm not losing out on any money. We just get to walk away from the contract. That's pretty common nowadays. It's something that you'll usually see in there, but if it's not in there, it's probably the most important clause I personally believe that you need to make sure is in there. So once that's done, then you'll get formal approval from the bank for the loan, and then it will be set. You'll be able to proceed to settlement. So this involves your conveyancer, the bank, and also the vendor, which is the property owner. So that they will meet either in person or online, and the property will exchange hands. Now, when that exchange is done, you officially own the property. The bank has given the money to the seller, and that means that you officially own the property. And that means you officially have mortgage payments too. So the most important thing going forward is to make sure that you have a tenant in your investment property that is covering those payments, because over the long term, you don't want to be doing that yourself because you're trying to grow your wealth. So you'll be looking at getting a tenant to rent in that property for whatever that may be. So I think for the first deal or the second deal, it's worth getting a property manager, and they will handle all of that to do with like taking photos of the property. They'll source someone to do that, the listing on realestate.com. This obviously costs a little bit of money, but it will look very professional and you'll find a tenant quite quickly. On our Brisbane property, we managed to get a tenant within 2 weeks because there is such demand for rentals up there. So that is the first step to buying an investment property. But it doesn't stop there, because you can purchase multiple investment properties, obviously. So what happens over time, if you're buying in a good area, you have what's called appreciation. And this means that the value of your asset is going up over time. So like the stock market has gone up over time, real estate has also gone up over time. Now, depending on where you buy, you might see appreciation or you might see depreciation if you do the wrong kind of investment. So that's something you definitely don't want to do, is buy into a bad area. Because being leveraged, the moves are obviously going to be a little bit greater than just what you would expect from the stock market. So let's say that you purchase a house for $500,000, you hold it for a couple of years, and the market has gone up quite a drastic amount, like it has in the last couple of years. This has been quite unusual, but it is something that has happened. And now your property is worth $700,000. So that is $200,000 of additional equity that has become part of your property just from appreciation over time. So this is one of the most important components of property investment. It's not only just the tax benefits that are fantastic, but it's the ability for you to get hold of cash, which you didn't actually have to earn yourself. It's just through holding assets. So when you purchase a property, and it goes up in value over time, you have a little bit more of a stake in the property. So let's say you had to put $50,000 down, that means that your mortgage is $450,000. But if you have a property that's worth $700,000, a $450,000 mortgage is giving you a lot of equity in that property. So what that means is that you can do what's called a cash out refinance, which means that you can take money out of your property to go and invest in new deals, completely tax-free. So when you start using this money that you have from a cash out refinance, obviously you'll be paying an interest rate on that, but if you have properties that are highly cash flow positive, this doesn't matter because your tenant will be paying it. So obviously it's worth mentioning that it can be a risk to have this, but if you're purchasing the right properties and you're continuing to see appreciation over time, this will not be a problem. So this is money that is completely tax-free. You can just pull it out of the property and use it to go and invest in other deals, which is a brilliant concept, and it's exactly what we're doing on the last two properties that we have, number 3 and 4. So this is one property that we have in Adelaide and another one that we have in Brisbane. Now these two properties are bought completely with equity and the bank's money. This is not something that we've actually had to put our hands in our own pockets to do. And this is why property is such a powerful tool for people, because it means you can use other people's money to make yourself wealthy. Because, you know, it's a win-win for everyone. The tenants are getting somewhere that they can live. You're owning a property that is going up in appreciation, getting paid to hold that, and the banks are also earning money on the interest. So it's a win-win for everyone, which is fantastic. So obviously over time, what you can do as your property portfolio continues to grow, you can pull out money from your portfolio and go and invest in other deals. Now, of course, it's really important to pay attention to how much debt you are taking out, because if interest rates do go up, then you can get yourself in a place where you're getting stuck. And that is what it's going to look like going forward, so you need to manage that risk. But having said that, it's still an incredibly powerful tool if you have the ability to service those repayments, or you have the tenants in place to service those repayments. Now, on top of this, you also have the tax benefits of real estate, which are fantastic. You can depreciate the value of the construction over the course of many years, many decades. This will give you a reduction in your taxes. So let's say the construction was worth $300,000 and goes down in value roughly 2% or so. You'll be able to deduct that 2% from the $300,000 every single year against your taxes by paying someone to do a depreciation schedule. And this is also something pretty amazing, because you're not only getting appreciation from the property, you're getting paid by tenants, you can also write off the cost over time of the construction on an investment property. So that is basically how you get started as a property investor here in Australia. This is also a strategy that works all around the world. But the beauty of using other people's money and using debt is that you have the ability to grow your wealth very, very quickly. Now, taking on debt, as I've said before, it's very important that you take all of those risks into account when you are investing. But so far, this is a strategy that has worked out phenomenally for me. I've managed to grow a net worth of over $1 million in just a few years. And on top of that, we're holding about $3 million of property. So it's been great so far. We're going to be continuing to work on this and paying down some debt and purchasing new properties. So if you've got any more questions about investing and how to get started, then please leave me a comment or send me an email. I'll be happy to chat with you about how to get into the investment property market, because it can be quite daunting to start with, but once it's all broken down and you've gone through the process once or twice or a few times, then it becomes a lot easier to do. So thank you guys so much for watching. Please make sure you like and subscribe to the channel. If you want to start your investing journey in the stock market, I have a link to Stake in the description. And on top of that, if you want to track your net worth, I have a link to WeMoney. So sign up and I'll give you $5 for free just for signing up, so you can track your net worth there. It's fantastic. I'll be looking at starting a buyer's agency shortly to help people on their investment property journey as well. So if this is something that you might be interested in, then please send me an email to get early access to that. So thank you guys so much for watching. Please make sure you like and subscribe. My name is Seeney from the Australian Wealth Channel. We'll see you later. Thank you.